Coming up on the SBS on the Money podcast, the Reserve Bank cuts interest rates for the second time this year and says that US tariffs may be disinflationary for Australia, and Telstra lifts prices on some of its plans. All the details next. Hi everyone, it's Tuesday the 20th of May 2025. The Australian share market rising today by 0.6% to 8,343, getting a bit of a boost after the Reserve Bank cut official interest rates by 25 basis points to 3.85% as expected. And within half an hour of the announcement, each of the big four banks confirmed they'll pass on the cut in full to their variable home loan customers. NAB the first with the news, with the new rate coming into effect from the end of the month. That's the same for CommBank and ANZ, although those with Westpac will have to wait a few more days after that. Some savings rates will also be reduced, but for borrowers, those with a $500,000 mortgage over 25 years, CanStar says they'll see their monthly repayments drop by $76, obviously more if you're on a higher loan. So for more on what this means for the economy and if we'll see further rate cuts, I spoke with the Chief Economist at NAB, Sally Auld. So Sally, you expected a 50 basis point interest rate cut today, but the RBA delivered 25. What perhaps did you see in the economy that the RBA didn't, and ultimately, why did they cut?
So I think, we know from the governor's press conference that we weren't too far off the mark. They did discuss, the merits of a 25 versus the merits of a 50. And as the governor said today, a stronger argument, I guess, for a 25 versus a 50. Our view was really predicated on the idea that, by the bank's own admission, a cash rate of 4.1 is restrictive monetary policy. And I think we felt that enough had shifted both with the global backdrop and the domestic backdrop, that there was a reasonable impulse for the bank to get back to a more neutral setting of monetary policy sooner rather than later. And we thought probably the most efficient way to do that was to cut by 50 in today's meeting.
You mentioned that global backdrop. Just how concerned is the RBA about US trade policy and the implication for the economy? And is that what they're referring to in its statement, where it said that the board considered a severe downside scenario and noted that monetary policy is well placed to respond decisively to international developments?
Yes, that's right. So I think there's two dynamics going on. One is that the domestic economy hasn't picked up as much as the Reserve Bank had expected. And so they acknowledged that and said, actually, household consumption in the first quarter was softer than we anticipated. So part of what they're doing is responding to weaker consumption outcomes, but also acknowledging that inflation is now, I think, far more comfortably from their perspective in that target band. So those two things on the domestic economy are important. But clearly, one of the biggest shifts since they last met in early April is what's happened with US trade policy. And as the governor said today, that's been a real roller coaster, as we all know. But they are now clearly more worried about downside risks to global growth. And also they've made the assessment that the net impact on all of this is going to be disinflationary for Australia. So that's a new sort of dimension to everything that's going on. But they have, for the first time, set out some scenarios. So they said they've got a baseline scenario, which is effectively assuming that everything stays where it is with tariffs, that the Chinese government authorities deliver some fiscal stimulus. And in that scenario, we get inflation continuing to come down to around the midpoint of the target band, get the unemployment rate a little higher, and we get growth a little bit lower. And then they've talked about two other scenarios, one called trade peace, where everything goes back to where it was pre-Liberation Day, and one called trade war, where you get a re-escalation of tariffs. And that delivers, based on the assumption that the cash rate gets to about 3.4 by the end of the year, some pretty nasty scenarios for the Australian economy, an unemployment rate closer to 6% and much lower GDP growth. So that trade war scenario is really one that is built entirely around a meaningful re-escalation in trade issues.
Is it fair to say that even though the governor said that the trade war overall will be likely disinflationary in Australia, although there's still some upside risks to the other side, right? It's still revised down its expectations for underlying inflation to the midpoint or close to the midpoint at 2.6%. Mm-hmm. So with all of that in mind, what does it mean for the timing of the next rate cut, assuming that's the next move, and how many are there likely to be?
Yeah, that's right. So, I think the one thing the governor was really clear about explaining today is that as we sort of intuitively know, there is a lot of uncertainty at the moment out there. And so she made the case that, we still have to be very data dependent. And they will, as they approach meetings in July and then the next one after that in August, those will sort of coincide with the expiry of some of those 90-day deadlines. So the first one that was announced on April the 9th, and then the second one that was announced in terms of the agreement with China. And so it's quite possible that as we approach the next couple of RBA meetings, I think noise and volatility around, where we're ultimately going to settle with tariffs starts to pick up. That might be detrimental to financial markets, to confidence across households and businesses. And so I think it's quite possible that they continue on a path towards lower rates. And at NAB, we're expecting them to cut again in July and again in August, and then with a follow-up cut a couple of months later in November. So we see them getting to 3.1 on the cash rate before the end of the year. And that's just based on the idea that, that baseline scenario that they have in seems to be running some asymmetric risk. So it's assuming no further escalation. It's assuming a pretty decent pickup in consumption in the current quarter. We think maybe risks around those two things are probably tilted the other way.
And final question on the consumer. I want to get your take on how consumers and borrowers are placed, because what I find interesting is that most appear to be keeping their repayments when it comes to mortgages at higher levels, with only 4% of eligible borrowers at NAB requesting a reduction in minimum repayments following the February rate cut. So what does it say about how the consumer's feeling?
So I think what that tells us is that the consumer wants to pay down debt. And so the consumer effectively has a deleveraging mindset at the moment. So additional cash that comes into consumers' wallets is being used to pay down debt. And that reflects really, I think, quite a cautious consumer. And that's actually, what we've seen in the real data. Like we saw a soft quarter for consumption in the first 3 months of this year. And so even though consumers did seem like they sort of came alive a little bit in the last 3 months of 2024, they really went back into their shells in the first 3 months of this year. And I think, possibly uncertainty around the outlook, I guess that experience of, having to manage mortgages through a period of higher rates, and also, perhaps a sense that, people just want to be a little bit more cautious in terms of their household finances after a cost of living crisis, I think is possibly being reflected in a lower willingness to spend and a higher willingness to continue to pay down the debt and hopefully get the balance sheet in a little bit better a position.
That's the Chief Economist at NAB there, Sally Auld. Now, Market Day on the SBS On The Money podcast. So investors like the news, with the ASX 200 climbing after 2:30 Eastern when the decision came through from the Reserve Bank. The S&P ASX 200 closing at 8,343. That's a rise of 0.6%. For more, Rhayna Bosch spoke with Catherine Allfrey, Portfolio Manager at Wavestone Capital.
So, Catherine, today we've had another move by the Reserve Bank. Can you talk us through how markets are reacting to this today?
Markets have reacted positively to this today, which is interesting given that the market had already priced in, the bond market that is, had already priced in the cuts of 75 basis points this year. But I think they like the language that the Reserve Bank is using in terms of some of the inflation, the fact that we're back within the trim mean range, the fact that some of the inflationary forces that we've seen over the last few years, migration, food prices, building costs, they're all coming down. And so I think that the RBA is keen and looks like it will cut another 2 times this year.
And is that what the market is saying? How many more cuts are they expecting and why?
The market's expecting another 2 rate cuts, 25 basis points each this year. The interesting thing, I think, in terms of the language that was used today is that you shouldn't expect another cut next month. It's more likely in August. The Reserve Bank is still going to be weighing what's going on from a global perspective, but also wants to see, inflation behave itself over the next couple of months before you get another rate cut. But positively, the market is pricing in another 2 cuts.
So what does this all mean for investors?
I think it's quite a positive backdrop in terms of for equities in Australia, and the fact that we've had tax cuts, we've had the government come back into return. We've also now clearly got a bias to rate cuts coming through. But we have seen a real strong rebound in the market after we saw that sell-off with Liberation Day at the beginning of April. So we are now back up at the highs, believe it or not. But there are still some positive trends that could come through over the next 6 to 12 months.
That covers the domestic market, but how about international factors? I mean, we've got trade wars, geopolitical tensions. To what extent are they worrying you right now?
Look, of course, we're worried about what's going on offshore, and particularly in the era of strong men around the world that we seem to have ourselves now. And clearly the tensions from a geopolitical perspective, the market is more concerned around trade than they are with skirmishes in terms of Middle East or Ukraine. And they're also concerned about the overall level of global growth. And unlike a few weeks ago, when people could see, recession on the cards in the US, it seems that is unlikely now. And so that's given that, sort of positive backdrop to equity markets.
Moving on to some corporate news, the CBA has hit another record today, at least at one point. That's despite ongoing commentary that the bank is overvalued. Given it's the biggest company on the market, I'm keen to get your take on it.
Look, CBA, I've always been a CBA fan. It's a very well-managed bank. It clearly, for 35% of Australians, it's their main financial institution. It has consistently outperformed its peers. It is extremely well managed, whether it be from a capital or provision perspective, and clearly that is now fully reflected in its share price. One of the reasons people have to understand as to why the stock has kept performing is not only the passive flows into index funds and super funds continuing to put money into the indices, but also CBA has continuously over-delivered in terms of what the market was expecting in terms of their earnings. And so therefore it's been in this continual upgrade cycle. And so what we've seen is quant funds continue to own the stock and buy the stock with that positive earnings revision coming through. And so to put it in context for your viewers, over the last 12 months, we've seen 11% increase in brokers' forecasts for CBA. And that is versus a share price performance up like 45, 50%. So it's clearly outperformed that, which means it's trading at 27 times PE, and it's the most expensive bank in the world. But it has performed exceptionally well from a management perspective, but also actually the bank has delivered.
Another major market player, Telstra, is also in the news today after hiking some of its customer plans by between $3 and $5. Its shares were up on the news. What are the challenges that Telstra is facing, and to what extent is this a good move?
Well, it's not particularly a great move for customers when everything else prices seem to be coming off, and now we've got mobile prices going up more this year than last year. Well, they do have to be careful because, we have seen the government turn on certain sectors in the economy. We've seen it in banks, we've seen it in supermarkets. We've talked around insurers, and so maybe the telcos will be next. So that will be interesting to see how that plays out. But, Telstra's going through a similar journey to everyone else. It's got wage increases coming through, and so therefore it's got to cover its costs, and it's got to make a return on the capital it's investing to support that mobile network. And so that's why it's asking consumers to pay more.
Some tech stocks doing really well today, like Technology One. What can you tell us about that?
So Technology One had its first half result today, and it was a better than expected result. The company reported $63 million of profit, which was up, circa 30% year on year. They are a technology company that sells software predominantly in the government and education space, and they've expanded not only here in Australia, but also now having a great success in the UK. And so that company has been actually one of the best performing stocks on the market.
Finally, Catherine, what are you telling investors at the moment, or your clients at least, about the opportunities in the market?
Well, the market's had been, like we've been talking about, it's had a real V-shaped recovery since the bottoms were hit just after Liberation Day. So we are cautiously optimistic. A lot of stocks are looking pretty fully priced. So it really is what's going to be interesting, I think, over the next 6 to 12 months is what companies do on the M&A front. So we're seeing an increase talk of transactions, a lot of it bolt-on. We'd like to see that in terms of bolt-on transactions as opposed to, big bang transactions like we saw from James Hardie in the United States. That was a poor acquisition. So that's what we're talking about with our clients.
That is Rhayna Bosch speaking with Catherine Allfrey from Wavestone Capital. Don't forget, if you enjoy the podcast, to give it a rating or review on Apple Podcasts or Spotify and to click subscribe.
This SBS On The Money stream is provided for informational purposes only. The content in this stream should not be understood as constituting advice or a recommendation. It is not personal advice and it does not consider your personal circumstances or objectives. You should contact a licensed professional before making any financial decision.